In today's video, I want to touch on 10 hated stocks that could turn it around in 2025. In the previous video, we touched on 10 top stocks for 2025, and some of you have asked about specific companies, and I said, just wait for this video, because in this video, I want to focus on stocks that did get hit in 2024, but I do still think that the business is on the right track, and I think that's going to be reflected in the stock's performance in 2025. Of course, I can be wrong. And even if there is not a full turnaround in 2025, these are companies that could be long-term and should be long-term winners if they continue to execute correctly. Of course, not here to waste your time, so the names will pop up on the screen. And I do hope you keep watching. And yes, these are companies that we did touch on this channel quite a lot this year. So if you enjoy these type of videos, leave it a thumbs up, subscribe if not. We're very close to reaching 70,000 subscribers. So I really appreciate all the support that you've given me this year. I really appreciate that. I think 2025 is going to be the year where we could be touching and probably should be touching 100,000 subscribers. So thank you very much for all the support. Happy holidays, happy New Year's as well if I don't see you until next year. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Now, company number one I want to talk about is Uber. Now, just because it's number one does not mean this is the number one ranking. No, the list here doesn't change anything. Uber got hit more recently, right? Year to date, the stock is now basically flat, but at one point back here in October, the stock was up 40% year to date. So a huge decrease in the last 2 months or so. Now, Uber has a market cap of close to $130 billion and a forward PE of just 18.9 times. I say just 18.9 times because this is a company that is still expected to grow quite quickly in the next coming fiscal years. Now, of course, we know why the stock got hit, because of the fears that autonomous vehicles such as Tesla and Waymo are completely going to destroy Uber's business in the next couple of years. While I do think they are going to have an impact on Uber, I just don't see how Uber's business worldwide is going to be destroyed anytime soon. Currently, the average analyst price target sits 46.26% higher than the price we're at today. And if we look at some pricing metrics, very cheap compared to the 5-year mean, or in some cases, the 2-year mean. Forward PE, EV to EBITDA, price to sales, price to free cash flow. If you look at price earnings to growth, that sits at just 0.46. And so if we look at the expected growth rates for Uber when it comes to free cash flow is expected to grow 88.2% for the whole of fiscal 24, then another 22.1% in fiscal 2025, and then accelerate in fiscal 2026, growing 26.3%. When we zoom out a little bit, we look at total revenue, free cash flow, and free cash flow margin. We can see that this is not only a business that is growing, but it's growing now in a profitable way. And then if we look at total trips and gross bookings, I mean, since 2016, it has grown quite a lot. Of course, the pandemic here, they did take a hit, but after that, if you look at gross bookings, total trips, all have gone up quite quickly. Now, I do want to say that, yes, autonomous vehicles and all of that is a risk, but I also want to say that Uber is invested in multiple companies that deal with autonomous vehicles. Also want to say that Uber's management, Uber the company, will not stand still. It's not like, oh, okay, autonomous vehicles are going to be a thing and we're just going to see what happens. No, I'm pretty sure they have something that they will come out with in 2025. Now, this might not be their own autonomous systems, right? They did try it a couple of years ago, didn't work out. They focused on being the platform. And that's the thing here. We're only one partnership announcement away for this stock to skyrocket. Whether or not that will be announced in the next coming months remains to be seen. But if we purely look at the core business right now for Uber, there are really no signs of it decelerating. So yeah, overreaction in my opinion. Moving on to company number 2, and that's a dividend paying one. Yes, one that we have not touched on for quite a long time, and that's Pfizer. Pfizer year to date is down 2.11%, has a market cap of $150.52 billion and a forward PE of 9.9 times. Does pay a dividend, has a dividend yield of 6.48%, so quite good. Of course, if we zoom out a little bit, we can see that during the pandemic, the stock was much higher, but then again, so was revenue and profit. If we look at the expected growth rates for this company, yes, there is some strong growth in sales and EPS for fiscal 24, but fiscal 25 is basically a year where everything's going to be flat. And then we see a small acceleration in EPS growth in fiscal 2026. If we look at the current average analyst price target, that sits close to 20% higher than the price we're at right now. And then the pricing metrics. We are lower on a 5-year mean when it comes to forward PE. EV to EBITDA is about the same. Price to sales is a bit lower, 2.4 times. Price to free cash flow, that's in the last 12 months, sits also quite close, 18.3 times. Price earnings to growth sits at 1.36. Now, of course, with these types of companies, you're not really expecting super growth, but you are collecting a nice dividend. But despite this slow growth in revenue that we've seen, or the expected growth, we can see that free cash flow is expected to be up 126.6% in fiscal 24, followed by another 60+% growth in fiscal 25, and then decreasing by close to 6% in fiscal 2026. So yeah, sales growth, EPS growth might not be super attractive, but free cash flow is expected to grow quite quickly. Looking at where the revenue is coming from, as you can see, this is the outlier here, 2022, huge increase in primary care revenue, and then a huge decrease. You've got primary care revenue, specialty care revenue, oncology, and then business innovation is basically that tiny purple bar. And so I would call Pfizer a value dividend play, right? It's pretty safe at these prices because, let's be honest, Pfizer isn't going anytime soon. Yes, maybe pharma, there are some fears right now with the Trump administration, RFK and all of that, but Pfizer still is a global company, so yeah, I think they'll do well in the future, not as well as 21 and 22, thank God, because that means that we are not going into a pandemic, but yeah, dividend investors definitely like this stock right now. Up next, company number 3 is a company we touched on a couple of days ago, and that's Enphase. That's in the energy side of things. We also did touch on Enphase and First Solar, I think a month or two ago. Great options going into 2025, in my opinion. Right now, Enphase has a market cap of just under $10 billion. Year to date, the stock is down 44.75%. In the last 3 months alone, this stock is down 35.5%. Has a forward P of 21.3 times, and as you can see and have guessed, fiscal 24 is a horrible year for the company, but then in fiscal 25 and 2026, sales and EPS is expected to grow quite quickly. Looking at the average analyst price target, that sits close to 31% higher than the price we're at today. And then the pricing metrics, all of course lower than the 5-year mean, and here price earnings to growth sits under 1, meaning by definition this is undervalued. When looking at free cash flow, of course, in fiscal 24, free cash flow is taking a hit. It's expected to be down close to 30%, but then it should grow 27.6% in fiscal 25 and another 19.1% in fiscal 2026. Where do they generate their revenue? Well, the majority comes from the US and then the other part from international. And I do still think that international, although in the short term, especially in Europe, you're going to face some headwinds. I think in the long run, it just becomes a no-brainer that international should grow maybe a little bit slower, but should grow quite close to the rate of the United States. As of right now, if you look at the last 12 months microinverters shipped, of course, a huge decrease compared to, well, 21, 22, and 2023. But as we enter lower rates environment, I think the demand for solar is definitely going to reaccelerate. Yes, I know there are some fears that, with the Trump administration, solar could get hit. But I think that's the opposite. I think with Trump surrounding himself with a lot of tech CEOs especially, they are going to make sure that, investments in solar are going to be made. Investments in clean energy, because you want the United States, or they want the United States to be energy independent. So I think solar is the obvious choice here. Yeah, maybe tax credits and all of that might decrease a little bit, but then again, Enphase, an American company, I highly doubt they want them to fail. Up next is one of my personal favorites, and I say this because I'm probably one of the only ones that still believes in this company, and that's Intel. Now, Intel this year is down close to 60%, has a market cap of $88.16 billion and a forward PE of 29.3 times, which of course, if you look at Intel's performance, is quite expensive, right? If you look at fiscal year 2024, sales decreasing by close to 3%, EPS being negative, but of course that should change in fiscal 25 and fiscal 2026. Right now, the average analyst price target sits 19% higher than the price we're at today. And then looking at the pricing metrics compared to the 5-year mean, well, there is no free cash flow, so that's out of the window. Price to sales is lower at 1.6 times. EV to EBITDA is lower as well. PE, forward PE here is higher, but yeah, I mean, the E was also thrown out of the window. And with Intel's expected growth, right, in the next coming fiscal years, top and bottom lines, we can see that the market is still expecting free cash flow to be negative by fiscal 2026. Since we are also going to talk about AMD in this video, here's a small comparison between AMD's client revenue and Intel's client revenue. Still, Intel much bigger than AMD. But if we look at data centers, because let's be honest, that's where the majority of the money and the profits are from, we can see that last quarter, AMD did surpass Intel for the first time. And now with Intel in 2025, the big story is going to be Intel 18A. I think Intel 18A is going to be the turnaround story for Intel if, of course, it turns itself around. If the execution is good. Yes, I know we're still waiting for the new CEO, but the roadmap has already been set. So it's all about executing correctly. The foundry losses for Intel should also improve as they move towards 18A. And then, yeah, remains to be seen what happens with the PC refresh cycle, AI demand, and all of that. From a consumer's perspective, servers as well. It's up to them. It's up to them to deliver products that the market really likes and wants at a good price. Good price for the consumer and good price for Intel for their margins. Yes, it's an uphill battle, but I think we're quite close to the bottom. You might agree, you might disagree, that's up to you, but Intel for me is for sure on this list of turnaround stories for 2025. Moving up to the next stock, a more energizing stock, shall I say, and that's Celsius. Celsius is also down quite a lot this year, despite it being up at one moment close to 75%. It's now down close to 50% year to date. It has a market cap of $6.51 billion and a forward PE of 32.3 times. Now, as you can see, EPS is expected to get hit for fiscal 24, but then we see a solid reacceleration in fiscal 25 and fiscal 2026. There is a big hit this year because of Pepsi, which is quite ironic because the huge gains was also because of Pepsi, or should I say thanks to Pepsi. If we look at the average analyst price target, that sits 45% higher than the price we're at right now. And as for the pricing metrics, it is of course lower than the 5-year mean. Forward PE, EV to EBITDA, price to sales, price to free cash flow, price earnings to growth is quite high right now, 3.91. But despite the huge slowdown, we can see that this is still a free cash flow positive company, and free cash flow is expected to increase 7.2% in fiscal 25 and then another 32.5% in fiscal 2026. If we look at where revenue is generated, of course, the majority comes from the United States, but internationally, as they expand in more and more countries, that is growing quite nicely. If we look at the percentage of revenue coming from Pepsi, Costco, Amazon, and all others, we can see that, well, the reason why this stock is down is because of inventory issues that Pepsi basically created. They had close to 60% of total revenue. So, of course, if they stop ordering, then yeah, they take a huge hit. But on the flip side, once these inventory issues are behind, well, we should expect new orders to come in. And then with the year-over-year comparisons, that does become much easier to beat in fiscal 2025. And so, yeah, sometimes you get these maybe artificially good looking quarters, right? Where, 70% year-over-year growth. But then if you look at the same quarter last year, you can see that it was an extremely weak one. So yes, 70% does look great on paper, but it's just huge growth because the same quarter last year was just extremely weak. I think that's what we're going to see moving forward when we're going to lap those weak quarters that were created because of those issues. But all in all, the trajectory here is quite clear. It's up and to the right, and especially as they expand in more and more international countries. Now, There is also a risk, and I've seen this in the comments before, oh, RFK is going to come after these types of drinks. I think energy drinks like Celsius are not that high on the priority list. That's just my opinion. Moving on to the next one is another company we did touch on, I think yesterday or 2 days ago, and that's a Chinese company called Alibaba. Year to date, the stock is actually up 13.4%, although at one point here after the first stimulus move, this stock was up 54.8% year to date. Now has a market cap of $195.2 billion and a forward PE of just 9.4 times. Yes, I say again, just 9.4 times, because if you see the expected growth rate for this company, I mean, this is quite cheap. Currently, the average analyst price target does sit 40% higher than the price we're at right now. And what's interesting to me is that, well, before the stimulus move, before the stock moved quite quickly, the average analyst price target was quite flat-ish. But then when the stock went up on that move, suddenly we start seeing some upgrades, right? It went up, the average analyst price target basically went up by 20%. In my opinion, why is that? Well, it's because they saw the stock price suddenly soar, so we have to follow the price movement. And currently looking at some pricing metrics, of course, it is much lower than the 5-year mean, but it has been much lower than the 5-year mean for quite a while. Price earnings to growth sits at 0.61. Looking at free cash flow for Alibaba, it's expected to be down 11.6% for fiscal 2025 as they invest more and more in their business, but then should reaccelerate in fiscal 26 and fiscal 2027. Looking at how they generate their revenue, well, the big part comes from China, Taobao and Tmall Group. Then you've got the Cloud Intelligence Group, Alibaba International, China, the Logistics Network, and Digital Media and Entertainment Group. From an adjusted EBITDA standpoint, the big chunk comes from Taobao and Tmall Group, and since that part is the largest chunk of revenue, right, as we've seen right here, they're also facing more competition, plus the Chinese economy was not doing quite well and still not doing that well. So we've seen that part here decreasing or at least not grow for quite a while. Now I know, Alibaba and other Chinese companies might not be your cup of tea because, well, those are Chinese companies, you don't directly own the shares as well. I understand that, and you definitely have to take that into consideration when you buy these types of companies. Moving on to another, let's say, controversial pick, and that's one we also covered more recently. That's a company out of Sweden, Evolution AB. Now, this one is also quite an interesting one because, well, the stock is down close to 30% year to date, pays a small dividend, but it's still growing extremely quickly, all things considered. It's still expected to grow 13% year over year in fiscal 25 and 2026 when talking about sales, and then close to 15% in both of those fiscal years if you look at EPS. Right now, the average analyst price target sits 62% higher than the price we're at today. And looking at some pricing metrics here, it is of course lower than the 5-year mean on all of them. Price to earnings, EV to EBITDA, price to sales, price to free cash flow, price earnings to growth sits under 1.82. Looking at free cash flow is expected to take a small hit in fiscal 24, down 3.9%. But then in fiscal 25 and 26, it's expected to accelerate. Growth of 15.9% in fiscal 25 and then another 18.7% in fiscal 2026. And if we zoom out a little bit, I mean, yeah, this is one of those companies that maybe if it wasn't a gambling, gaming type of company, everybody would like to buy these types of companies. For those that don't know, they generate the majority of their revenue through live revenue, live gaming revenues, and the rest, which to be honest right now is a little bit of a disappointment, and that's RNG, that's random number generator revenue. They did acquire some companies, some studios, but that, as you can see, has not played out as they thought. They say that things should improve moving forward. And of course, more recently, we've had more, let's say, bad news out of the UK. We touched on that. I think they will just pay a fine and be done with it. Moving on to the next company, and we're going back into the semiconductor space, and that's Micron. Now, Micron did take a hit more recently because of the earnings report. More specifically, their guidance was much weaker than expected. Micron right now has a market cap of $100 billion and a forward PE of just 11.5 times. Yes, here as well, you can see the growth rates are quite insane for such a low PE. For fiscal 25, 26, and then in fiscal 2027, the market is expecting, let's say, the growth cycle to be over. Currently, if we look at the average analyst price target, that sits close to 47% higher than the price we're at right now. And then looking at some pricing metrics, forward PE, EV to EBITDA, price to sales, lower than the 5-year mean. Price to free cash flow, since that is in the last 12 months and prior to, last quarter, was no real free cash flow, that is now much higher. But price earnings to growth is extremely low here at 0.31. And here you can basically see the free cash flow story in the last 12 months, just $554 million. But for fiscal 25, that's expected to grow by over 2,600% to $3.32 billion. Then another 103.3% growth in fiscal 26, but then a decrease of 24.4% in fiscal 2024. I think that will not be the case. Overall, if we look at what has happened with regards to revenue, so we've seen a huge reacceleration in growth, right? The down cycle and then the up cycle. This was last quarter, the number that we've got, $8.7 billion. And this here is the number for next quarter, $7.93 billion. The expected number was $1 billion more than this, $8.9 billion. And that's why the stock went down. But they say that the second half of 25 should be much better. And look, we're going to get to over close to $11 billion in revenue. So yeah, like I said in previous videos, I think there are cycles with these types of companies, although now there is HBM in the story, but I do think that the top of the cycle is going to be much higher than the previous top. Looking at how they generate revenue, we've got the biggest chunk here from compute and networking, then we've got storage, mobile, and embedded. And of course, you can split it into two segments here, DRAM and NAND revenue, with DRAM basically taking the majority of the revenue. And of course, in this AI story, we talk a lot about memory, but in this case, we have to talk about HBM, high bandwidth memory. And in this case, there are a couple of big winners, SK Hynix, Micron, and then Samsung, whenever they will figure it out. So yeah, I do expect Micron to be a big winner in the next coming years. Despite maybe in 2026 reaching a top of demand, I still think that there will be plenty of demand for Micron products. Moving on to one of the last companies here, and that's TMDX Transmedics. Transmedics at one point was up 120% year to date, but it's now down 20.69%. It has a market cap of just $2.1 billion, forward PE quite high, 56.9 times. But again, looking at PE for this company today doesn't make much sense. And plus, if you look at the expected growth rates, this is a company that's expected to grow top, but especially bottom lines at an extremely fast pace. Looking at the current average analyst price target, that's 62, close to 63% higher than the price we're at right now. As for the pricing metrics, we don't really get to work with a lot here. Forward PE much lower, EV to EBITDA much lower as well. Price to sales 4.3 times compared to 12 times. But then again, we've had periods where these types of names were just extremely high, especially back in 2021, and it didn't really make that much sense. And so if we look at free cash flow for fiscal 24, free cash flow is still expected to be negative, but in fiscal 25, it's expected to turn positive, $19.6 million, and then $98.4 million in fiscal 2026. And yes, if you've been following this channel, these numbers have been reduced in the last couple of weeks. What was, let's say, the big issue? Well, last quarter, as you can see, was the first quarter where revenue was down quarter over quarter. All of those segments here, lung, heart, and liver, were lower than the prior quarter. They say it was because of seasonality. Now, for the next coming quarter, they did also reduce guidance a little bit for the fiscal year. And so if we did the calculation correctly, it should come either the same as what we've seen previously, which is not going to be great, or if they come in closer to the higher end or maybe even beat those numbers, then we should see a small reacceleration. But if it's another decrease, I guess that's going to be quite bad for the stock. But the overall story for Transmedics doesn't stop next quarter or a quarter after that. They have huge long-term goals, right? 10,000 cases by 2028. They're also going to introduce kidney. They're going to go internationally more. So you got tens of thousands of more cases that will be revenue generating for them, profit generating as well. Talking here about $1.2 billion, I believe, in 2028 compared to what's right now. That's quite a huge increase. But of course, here, execution is key. The CEO does talk a big game, right? He likes to talk. He likes to attack the competition as well. So he better deliver. Up next, and that's the last company of this list, and that's Advanced Money Destroyer. Advanced Micro Devices, AMD. It's a joke in the community here. The stock right now is down 15% year to date, has a market cap of close to $203 billion, and a forward PE of 27.7 times. Here as well, there was a point where AMD was up 43%. Now, if you look at what's expected in the coming fiscal years, you might say, okay, this is definitely a bargain here. And yeah, I could agree. We've been talking about AMD a lot more recently. And yeah, the expected growth rates are quite something. If we look at the current average analyst price target, that sits 46.4% higher than the price we're at today. And of course, if we look at some pricing metrics here, forward PE, EV to EBITDA, price to sales lower than the 5-year mean, price to free cash flow, because free cash flow was also negative, it's higher than the 5-year mean. But then if you look at price earnings to growth, 0.66, extremely undervalued. We can also see that free cash flow is expected to grow 228% for fiscal 24, then another 90.3% in fiscal 25, and then another 33% in fiscal 2026 to reach $9.33 billion. Where is that huge growth coming from? Well, you guessed it, and as we've seen previously, data center revenue is taking a big chunk of revenue. Then you've got client, gaming, and embedded. Gaming and embedded are basically dragging it down a little bit. There are some headwinds there that should be turning into tailwinds in 2025 and onwards. Then if you look at operating income, of course, here you can clearly see the big chunk coming from a data center. Now, we've recently talked about AMD and how they could become a $1 trillion company in the future only if they fix the software side of things, right? The main reason I would say why NVIDIA is just so far ahead is because they have been focusing on CUDA for, well, over 2 decades or so, close to 2 decades by now. That's quite something. AMD, they've known about the software issues for a long time, yet they still keep struggling. So we'll see what happens, but the bar, let's say the expectations are quite low. For next year, they will need to start the year with AI guidance that is quite high for the street. Yes, we know what has happened basically this year. The bar was set extremely low, and then they raised it each and every quarter. But that will not work again in 2025. The expectations are already much higher than 12 months ago. So we'll see what happens, but they definitely do deserve a spot on this list. So what do you think? Which company would you pick on this list? Which company would you remove and add? Let me know down in the comment section below. Like, subscribe, do all of that, and I see you all in the next one. Bye-bye.